Okay, let's jump into it. If you're running a business, or, even just kicking off the idea of one, getting your finances sorted is step one. Zero, really, essential.
Definitely.
We've dug into some source material here that really zeroes in on a core part of that, setting up and choosing the right business bank account.
That's right. This deep dive is all about cracking open the source material and pulling out the absolute must-know nuggets. We're going to look at why keeping your business money separate isn't just a good idea. It's foundational. And then guide you through the most critical factors this source says you have to weigh when picking the perfect financial partner and account for your venture.
Yeah, and we'll get into some specifics like the nitty-gritty of that separate entity idea, how to spot those fees that sometimes seem to hide in plain sight, and the practical trade-offs between maybe a big bank and, say, a smaller credit union. It's all in the source, and it's crucial stuff.
Absolutely. So the source material starts with a recommendation that's framed as pretty much non-negotiable when you're setting up shop. It says it's highly recommended that all business transactions run to a separate bank account, completely distinct from your personal accounts.
Right, not just nice to have, but highly recommended. And they don't just say do it, they give some really solid reasons why this separation is so critical. First off, they talk about the separate entity accounting principle. What's that about?
Okay, so this is fundamental to how businesses are viewed financially.
Hmm.
It's the principle that recognizes the owner's personal money and the business's money are two entirely different things.
Okay.
Because of that, every single business transaction, well, it needs to be recorded separately. The source makes it clear. Having separate bank accounts isn't just helpful for this, it makes it dramatically easier and, frankly, more accurate to actually follow that principle.
So it's not just some abstract accounting concept you can ignore if you're small.
Yeah.
It's the bedrock. But beyond the principle itself, the source also points out how practical it is. Day to day. Having a separate account makes it way simpler for you to actually see how your business is performing.
Hmm.
You get a clear snapshot of its financial health without your, I don't know, your personal grocery bill blurring the lines.
Absolutely. And think about tax time. Oh, boy.
Ugh.
This source highlights that keeping everything separate significantly simplifies calculating your business's income and expenses for tax returns. Things like bank fees become clear business deductions, and any interest earned on your business deposits is easily identifiable as business revenue. It saves time, headaches.
Which usually translates directly into saving money on accounting fees, right?
Precisely. Less untangling means less billable hours for your accountant, potentially.
Okay, so what here for you, the listener, is clear. Separating finances isn't just a rulebook thing. It brings clarity to monitoring performance and makes that annual tax dance a whole lot less complicated. It's the essential first step the source really emphasizes.
It really is.
Now, once you're bought into that, the next big hurdle the source tackles is actually picking the right account from the right financial institution.
Right. Because while the act of opening an account might seem simple,
Yeah.
walk into a branch with your ID, the source stresses that choosing the best fit requires careful thought about specific factors. It's really not one size fits all.
And they list several key things to scrutinize. What's first on their list? Where do we start?
Bank fees. Fees. Everyone's favorite topic.
Well, yeah.
The source gives a heads up that banks can have hidden or maybe not so obvious fees lurking around.
Okay. Hidden how?
Well, maybe not hidden exactly. What's crucial here, according to the source, is that banks are legally required to list all these fees in something called the Product Disclosure Statement, or PDS.
Yes, got it.
And they really emphasize that it's your responsibility as the customer to, actually read that document meticulously and ask questions about anything you're unsure of before you sign anything. Don't just skim it.
That PDS sounds like the place where the devil lives in the details, then. You need to put your reading glasses on for that one.
You really do. Don't assume anything.
Okay, so scrutinize those fees in the PDS. What else did the source flag as important when choosing?
They call interest rates probably the most important factor when evaluating accounts.
Wow, okay. Probably the most important. That's a strong statement. Why do they put such weight on interest rates specifically?
Well, because it directly impacts your bottom line in two pretty significant ways. First, it determines how much your business earns on any money just sitting in the account your deposits.
Okay, the earning side.
And second, maybe even more critically, it determines how much you'll repay if you use any credit facilities, like loans or overdrafts connected to the account.
Right, the paying side.
Exactly. A difference of even a small percentage point here or there can mean significant money over time, either earned or, paid out.
Makes sense. So fees and rates are top of mind. What other features should a business owner be looking for, according to the source material?
They mentioned considering an overdraft facility.
An overdraft, explain that a bit.
Sure. It's essentially permission from the bank to temporarily dip below a zero balance in your account up to a certain agreed limit.
Okay.
The source points out this can be a really crucial feature for a business that might have uneven cash flow. It gets paid in chunks, but has steady bills. It provides a short-term buffer.
Like a safety net, yeah. For those months where receivables are slow, but the rent is still due.
Exactly that.
And speaking of borrowing, they also cover credit cards, right? Business credit cards.
Yes, they do.
Yeah.
A business credit card can definitely offer convenience, no doubt. But the force strongly advises evaluating features like the maximum credit limit,
Sure.
and maybe especially the interest rate on any unpaid balances. They issue a pretty clear warning here. Many banks charge very high interest rates on credit card balances.
Oh, yeah, those rates can be eye-watering.
They can. So the source stresses that regular, ideally full repayment is essential to avoid getting hit with crippling interest charges.
Right. That high interest rate on credit cards is definitely a trap to watch out for. Don't let that convenience turn costly.
Absolutely.
Okay, what's the last factor they highlight?
The last one they cover is convenience and support.
The practical side of things.
Exactly. This gets into the practicalities of how you actually bank day to day.
Hmm.
The source draws a contrast between, say, smaller banks and credit unions, which might offer more competitive rates sometimes, and the larger commercial banks. They note that smaller institutions sometimes lack the extensive network of physical branches or ATMs you find with the bigger players.
Right, that branch access or ATM network can matter depending on your business type.
For sure. So the source points out the value of things like readily available local branches, maybe helpful staff you can actually talk to, reliable, secure online banking, good mobile apps, all that stuff.
Yeah, those aren't just nice to haves anymore, are they? Good online banking is pretty much table stakes.
Pretty much. And the source suggests these conveniences can genuinely ease the day-to-day burden of managing business finances. Less friction means more time for your actual business.
So you're really weighing a lot of things here then. It's the dollars and cents of fees and rates, potential lifelines like overdrafts and credit cards, but with warnings attached, and the sheer practicality of how easy the bank makes it for you to actually do your banking. It sounds like a real balancing act specific to your business needs.
That's exactly it. Understanding these different points that the source material brings up gives you a framework, a way to actively evaluate potential financial partners. It's really about finding the institution and the specific account that aligns best with how you operate and what you need to succeed.
Okay, so let's recap quickly. We've really unpacked the absolute core principle the source hammers home. Separating business and personal finances is non-negotiable, driven by that clear, separate entity idea. It just makes sense.
Foundational.
And we've walked through the critical factors they highlight for choosing an account, digging into fees, comparing interest rates, understanding overdrafts and credit cards, and considering convenience and support.
Getting these fundamental decisions right, based on the kind of insights found in this source material, it truly sets the stage for healthier finances and hopefully smoother operations for your business down the line.
Definitely. So here's a final thought to leave you with, kind of building on what the source laid out. The source explicitly called interest rates probably the most important factor. We heard that loud and clear. But considering how much they also emphasize the importance of digging into all those other details, like finding those not so obvious fees tucked away in the PDS, understanding the potential high cost of letting an overdraft or credit card balance just kind of linger, or even just the daily friction of banking that just isn't convenient for how you work. How might overlooking those seemingly less flashy details end up costing your business more in the long run than a slightly lower interest rate might ever save you? That's a really good question.
It's definitely something to really mull over as you set up or perhaps review your own business banking situation.